Welcome back to the Figure Annuity Sales podcast. It's Caleb North here, and Chad is actually out of town. He's in Mexico, and so I'm recording one solo today. But I'm excited to talk about some things that have actually come up last week. So last week we saw the Fed drop the federal funds rate by 25 basis points. And so what we're going to talk about today is the impact that can have in our products and what to expect in the future in the world of annuity sales as we are likely to enter kind of a rate drop environment. So I'm trying to get you guys ahead of the curve here, but as many of you probably saw last week, the Fed did drop the federal funds rate by 25 basis points. The target went from 4.25, it was 4.25 to 4.5 down to 4 to 4.25. The effective rate dropped by an equivalent 25 basis points. And here's the thing. I think a lot of times when we talk about rates, we use rates as a blanket term. We use just the word rates to describe the rates we have in our products. We use rates to describe interest rates. We use rates to describe yields, all kinds of different things that rates kind of gets blanketly thrown out on. And I think sometimes we can incorrectly assume that when the federal funds rate goes down and our interest rates go down, that simultaneously our annuity rates will go down. And here's the thing, it's not a wrong idea. It's just about 1 degree of separation off from what we should actually be examining. So here's what actually happens. When these insurance companies get money in the form of policies, right? And they sell a policy to your clients and they receive the funds. They put that money into the general account. General account goes to buy basically bond positions, primarily bond positions. And the type of bond that I like to use personally to track kind of the overall expectation of what we should be seeing in our annuity products is the 10-year treasury. So a lot of these carriers will buy, blocks of bonds in the 10-year treasury, and we'll see the yield of the 10-year treasury affecting the rates in our products more directly. So if you want a better kind of correlation between our annuity rates and something that you can kind of from the outside look at and try and track and see, what are we expecting here? Look at the 10-year treasury. Keep track of it. If you were to look at the 10-year treasury, you can see that we've basically been on a steady decline since, the 80s, really. It's kind of gradually decreased with little, ups along the way, but the general trend line is kind of like this until we got to 2019. And then we saw the 10-year treasury yield increase, and we've been on an uptick, and we've actually been holding pretty steady for the past year, and we've been at a higher point over the past couple of years than we had really since the early 2000s. And so we've seen our annuity rates be way higher than what we've seen them be for a decade and a half. And so it's been kind of a sweet time. But here's the deal. There is historically a correlation between the federal funds rate and the 10-year treasury. It's not a perfect correlation. They don't necessarily mirror each other. It's just that the general trends of the two tend to track pretty well together. And so as we see the federal funds rate coming down, what should we, based on historical evidence, expect? We should expect that our 10-year treasuries will also go down. And what will happen when our 10-year treasuries go down? We should see our annuity rates subsequently go down as well. We don't know when this is going to happen. The Fed has announced that there probably will be a couple more rate cuts even this year, within certainly the calendar year from point today to point next year. I would expect we especially see some more rate cuts over that time period. And subsequently, like I said, we should see the 10-year treasury decrease in its yield. And as that happens, we should see our annuity rates go down. Here's why that happens. When the insurance company buys these bonds, these bond positions, and they often buy them in ladders, but they're basically guaranteed some kind of yield. Well, the higher that guaranteed yield is from these bond positions, the more they have to be able to put toward their options budget. So when we see a greater yield in bonds, we're going to see higher MYGA rates. When we see a greater yield in bonds, we're going to see a higher cap rate, par rate, whatever it is across all of our indices. Why? Because they have a greater budget, because they're receiving more money guaranteed in these bonds. They have a greater budget to put into these index positions or fixed rates or whatever it is. When those yields go down from the bonds, we have a smaller budget. Well, think of it this way. If you go to the gas station with $20 and gas is $2 a gallon, you can buy yourself 10 gallons of gas. If you go to the gas station with $10 and gas is $2 a gallon, you can only buy yourself 5 gallons. That's what happens in our world, in our rates world, when we see the bond yields go down. Okay, we see these bond yields go down, we have a lower budget. We go to these counterparties with our budget, and I'm talking about the insurance companies that go to the counterparties with their budget, say, hey, this is what we've got. What kind of pricing are we seeing on these different index options? And the rates are what they are based on what they're able to buy, based on the cost of the options. Well, if the options costs aren't all that, they're not changing all that much, we're not seeing those go down, right? But our budget goes down. If the price of those options is the same, it's just like that gas analogy that I just gave. We're going to be able to afford less. So we're going to see our caps, we're going to see our par rates, we're going to see the caps and pars will go down, our spreads will go up. So just keep that in mind. As we see the federal funds rate go down, we should also see our 10-year treasury go down. That's pretty indicative of the bond market in general. As we see the bond market go down in its yields, we should see our index rates and our fixed rates go down in our products as well. So what does that mean? That means that we are probably on the doorstep of kind of what I would call a rate drop environment. Here's the deal. I think we're going to see across the industry less production in our products when these rates start to go down. Now, I don't think that has to be your story. I think that there are things that we can all do and ways that we can position the products and ways we should be positioning our products that is timeless, regardless of the rate environment. And we'll get into that into a second. But I do think that we're going to be entering this rate drop environment that over the last 2 years, we've been flashing these high bonuses, high caps, high par rates to these clients. And anybody that hasn't been moved by that, it's unlikely that they're going to be moved by lower rates, right? It's not like you can have a conversation with a client about a 10% cap and then in a year talk to them about a 6 or 7% cap and then be excited about it, right? It's like if the 10% cap didn't get them eager, the 6 or 7 probably won't either. Unless we also see market regression. Okay, now if you look at the federal funds rate and you look at the historical movement of that, the last time we had Fed rates this high was back in 07, 08. What happened in the market subsequently? We saw the market crash. Now, I think we're in a different environment. What caused that is I don't see that going on today. So we may not necessarily see a market regression, but I think a lot of people would agree that writing on the wall says we're maybe a little bit overdue for a bit of a correction. So if we do see the market kind of take a regressive movement, even if our rates go down, when we see the market moving backwards, we always end up with people looking for safety and security, guaranteed income, those types of things. So even if our rates decrease, if the market also falls, we should continue to see people moving toward our types of products. What would be a bad scenario for us in the annuity world from a production standpoint is if we see the market continue to trend upward while the federal funds rate, the bond yields, and our index rates go down. When we see that type of movement where you have the market going up and our rates decreasing, that's not a good environment for us from a production standpoint. But there are things that we can be doing and things we should be doing that, like I mentioned a minute ago, are timeless. Here's the deal, guys. I would say that at Retirement Realized Financial, our FMO, 70% of our production is income-based products, with maybe 30% being a mix of indexed annuities for accumulation and multi-year guaranteed annuities. Very few SPIAs, mostly indexed annuities with income riders. And if you were to talk to most IMOs out there, their data would not reflect those numbers. And I can tell you why their data doesn't reflect those numbers. It's largely based on the way agents ask the questions they ask. It's largely based on the way agents do their fact finding. We've pretty well pivoted our fact finding away from the traditional. In fact, I would say we've never done our fact finding this way, but the traditional way to do it is, is this a plan for accumulation, or are you looking for income? And it's kind of this question that assumes the client knows how either of those function, but they don't necessarily know how either accumulation or income in our products functions. And they've been preconditioned over the last 30 or 40 years of working to have a bias toward accumulation. So if you go into a client meeting and that's the essence of your fact finding about what they need, is you ask them a question that is loaded with preconceived notions and potentially incorrect ideas or misconceptions, you're probably going to get the majority of your people say, oh yeah, it's just accumulation. If you change the way you ask that question from, is this a plan for living or a plan for dying? In other words, are you intending to live on this money while you're alive, or are you intending to pass it on to heirs and beneficiaries? You get a clearer answer as to how the client intends to use these funds. People synonymize accumulation with the ability to take more money, and it's not wrong. But if that's what they're trying to do, is it's more about what they take than it is about what they make, then it's really not an accumulation play at all. It's actually an income play. And so we've got agents, they'll ask the question that way, and that's part of why we see such a high volume of guaranteed income sales. And I guarantee you that if a client is looking for how much they can take versus how much they can make, it's actually a plan for living as opposed to a plan for dying. If you're going in there with an accumulation illustration, and I've got an agent going in there with an income illustration, if that's the scenario, that income illustration is probably going to win the client's decision because it gets past their preconceived notions and their potentially incorrect ideas about how these either income or accumulation works in our products. So we see a ton of policies come through for guaranteed income. Here's the deal. That is not something that ever the need for runs dry. When you try to compare, an accumulation product as a safe product with upside potential, and you're looking at 10% caps and 50% participation rates in the S&P 500, that's a nice story. You get basically half the gains, none of the losses, sort of a deal. How long would you sit at the blackjack table if every time you lost a hand, you never actually took the loss, but every time you won a hand, you only got half the winnings? Sit there all day. That's a good story. When we see these rates come down, is it going to be as compelling to see a 33% participation rate in the S&P 500 and a 6 or a 7% cap? I don't know. Probably not. Point is, the income side always has a place. In fact, when you look on the history of our products, that's been the bread and butter of our products for all time. When you go back to the Roman era, and they were issuing annuities, and that's and what they called annua, and that's where the term annuity comes from. That's what it was all about, was income. Then you look at the history of annuities over time and how have they functioned. You look at what is annuitization and how does that work. It's all been about income. So this recent shift from annuities being an income generating product to an accumulation based product is really just a modern spin on our indexed annuities. And I guess you could make the argument on the variable side as well. But the historical norm for our products and the position they have has been on income. Even in a rate drop environment, clients are not going to stop needing retirement income. Social Security is not going to all of a sudden become enough for people. It's not now. It was never designed to be enough. It was not designed to be the sole purpose of it. As a matter of fact, when you go back to the Great Depression and when Social Security was created, it was designed to protect people against unemployment. Why? Because the normal retirement plan at the time was a pension. Well, if you have a pension plan, you've got a retirement plan. But if during the Great Depression, all of a sudden you have a massive unemployment rate and people are no longer getting pension plans, how are they going to retire? Now we got to figure out a way, Social Security. So it was designed to be there for people that didn't have their pension plan. Well, now we have 401ks and we've got Social Security. And people are curious with their 401ks about how much they can take and for how long, and they don't really have any certainty around it. So then in the 90s, they come up with Bengen comes up with the 4% rule. And now we're seeing 25, 30 years later, that might be too much. Well, sorry for all those people that retired in 2000 and would have run out of money by 2017 following the 4% rule. My point is, study the history of this stuff, guys, and recognize that, yes, the federal funds rate going down is probably going to cause our bond yields to go down, which is probably going to cause our annuity rates to go down. And while that's going to have a greater impact on our MYGAs and our accumulation-based indexed annuities, the income story will never stop being relevant for people. We'll probably see our payouts temper. Like right now, it's not crazy for a 65-year-old to go get, 7 to 9% of their initial premium paid out for the rest of their life guaranteed. That's not an uncommon payout. We might see that temper down to 4, 5, 6, but to guarantee what the risk-based side is saying, man, that might be a little high in our strategies, 4% being a little bit high in our risk-based strategies, but we can guarantee 4, 5, 6 even after these rates come down for life. It's still a compelling and relevant story. So all of that to say, guys, that's what's going on in the when you look at the Fed rate and you look at the bonds and you look at our index rates, that's what's going on behind the scenes there. But don't be afraid as we see these index rates come down over the coming months. Don't be afraid of that adversely impacting your business. I think it will adversely impact the total volume of annuity sales in our industry because a lot of agents are out there just selling accumulation because of the way they ask the questions. So here, this podcast is a call to a better way to fact find. Here, this call is a better way to have conversations with your clients, get to the root of what they actually need, figure out, do some retirement income planning for these people, and watch your annuity sales stay steady or even probably increase. So I hope this helps you guys. As always, reach out if you have any questions.